They found it 3 weeks ago, not all of it, just enough to realize the rest was gone. 13 million ounces of silver vanished from a vault 3 stories underground in Singapore, a vault that's supposed to be impenetrable, armed guards, biometric locks, the kind of security you'd expect protecting something worth over $1 billion. Except when they finally looked inside, really looked, most of it wasn't there. And the people who are supposed to deliver that missing silver, they have 29 days left. This isn't another banking scandal where some executives pay a fine and life continues. This is different because you can't print silver. You can't negotiate with physics. Either the metal exists or it doesn't. And right now, it doesn't. But here's what nobody's talking about yet. HSBC isn't alone. They're just the first domino. And when that domino falls on February 28th, every major bank in the precious metals business is going to face the same question. Where's the metal? Let me show you how we got here. Because this story starts with a lie so simple, most people never even think to question it. You buy silver. You don't want to store it yourself, so you pay a bank to keep it safe. They give you paperwork, official documents stating you own specific bars with specific serial numbers, allocated storage, they call it, your metal, your property, sitting in their vault waiting for you. That's what they tell you. What they don't tell you is what's happening to that silver while it sits there. The bank isn't just storing it, they're lending it to manufacturers who need it for production, they're leasing it to traders who want to short the market, they're using those same bars as collateral for completely unrelated trades. One physical ounce backing 3, maybe 4 different claims simultaneously, all while charging you storage fees. You still own it on paper. The contracts are legitimate, the serial numbers match, but the actual bars, they might be in London right now, or melted down in a factory in China, or promised to 3 other people who also think they own that exact same metal. The bank is making a bet. They're betting you'll never ask for it back. They're betting that even if some people do, most won't ask at the same time. For decades, that bet worked flawlessly. The system hummed along, profits rolled in, nobody questioned it. January of this year, a pension fund in Hong Kong decided they wanted their silver, 5 million ounces. Nothing unusual about the request. They'd been clients for 15 years. Never a problem. Standard delivery should take 2 weeks maximum. 3 weeks pass, no silver, just emails. Vague language about administrative delays and supply chain complications. But this isn't some retail investor they can brush off. This is a fund managing $12 billion. They don't accept excuses. So they send their own auditor to Singapore with a simple demand: show us the vault. HSBC can't refuse. The contract allows third-party verification. So they open the doors. They present the books. Everything looks perfect. Rows of silver bars, each one stamped and cataloged. 18 million ounces according to the official records. The auditor starts counting, not just checking paperwork, actually counting physical bars, adding up the weight, verifying what's real versus what's written down. 4.8 million ounces. That's what's actually there. The rest of the vault is empty space. When the auditor asks where the other 13 million ounces are, the HSBC representative freezes. He stammers something about temporary allocations, refining processes, metal in transit, but he can't produce shipping documents, can't show refinery receipts, can't prove any of it exists anywhere, because it doesn't exist. It never did. Within 48 hours, 3 more institutional clients request audits. Within a week, 12 more. HSBC issues a statement. Everything is fine. All obligations will be honored. Liquidity is strong. The usual corporate language designed to calm markets. Then an internal memo leaks. One line buried in the middle tells you everything you need to know about how serious this is. Projected acquisition cost per ounce, $312. Silver trades at $80 right now. If HSBC's own analysts are telling management they'll need to pay $312 to cover their position, that means they understand something the public doesn't yet. They know what's coming. They know that when they go into the market trying to buy billions of ounces that don't exist in available supply, the price doesn't just increase gradually, it detonates, and they have 29 days to make it happen. Now you might be thinking this gets resolved quietly. Regulators step in. Some settlement gets negotiated. Banks are too big to fail, right? That's what people thought in 1968 too. Let me take you back. After World War II, America held most of the world's gold, 20,000 metric tons, more than everyone else combined. They made a promise. $35 would always get you 1 ounce of gold, guaranteed. Walk into the Federal Reserve with cash, walk out with metal. Other countries believed it. Why wouldn't they? America was the superpower. The economy was strong. Holding dollars was easier than holding gold, so they trusted the promise. But America started printing more money than they had gold to back it. Vietnam War, expanding government programs, massive deficits. By the early 60s, the math stopped working, more claims than metal. France figured it out first. Charles de Gaulle sent a warship to New York and demanded France's gold. 200 tons. The U.S. had to deliver, too politically dangerous to refuse. But word spread. Germany wanted their gold. Switzerland, Italy, everyone wanted out at once. The U.S. tried to stop it. 8 central banks formed the London Gold Pool. They agreed to sell gold together to hold the price at $35, but the selling pressure was relentless. March 1968, they sold 400 tons in 1 week, trying to hold the line. On Friday the 15th, 200 tons in a single session. The following Monday, the London gold market didn't open. Queen Elizabeth declared a bank holiday. When markets finally reopened weeks later, the price had doubled. 3 years after that, Nixon ended gold convertibility completely. Everyone holding dollars lost purchasing power. Everyone holding physical gold watched their wealth multiply 24 times over the next decade. The pattern was identical, a promise that couldn't be kept, an expansion beyond what was physically possible, a crisis when people started asking questions, then collapse. It's happening again right now. Same pattern, different metal. Here's why silver makes this even more dangerous than the gold crisis. Gold is mostly monetary. Central banks hold it. Investors buy it. Industrial use is minimal. But silver gets consumed. Every solar panel requires silver paste. No substitute exists at industrial scale. Every electric vehicle uses 15 to 30 kilograms. Every smartphone, every computer, every 5G tower. The silver goes into the circuit board and it's gone. Not recycled, not recoverable, gone forever. Industrial demand alone consumes 1 billion ounces annually. Investment demand adds another 300 million. Total available inventory in every vault worldwide, 1.1 billion ounces. And not all of that is actually available. Much of it is already allocated, already promised, already claimed by multiple parties apparently. The math doesn't work even before you add the fraud. When you factor in 4.7 billion ounces of phantom positions that HSBC and other banks need to somehow produce, you're not looking at a supply squeeze. You're looking at mathematical impossibility. February 28th isn't just HSBC's internal deadline. It's the day the illusion shatters. When one major bank admits publicly they can't deliver metal they promised to deliver, every investor with an allocated account at any major bank will start asking the same question. Is my silver actually there? When they all demand audits simultaneously, when they all want physical delivery at the same time, the entire fractional reserve system in precious metals disintegrates. You want to know what that looks like? March 1980. The Hunt brothers, 2 billionaires from Texas who watched inflation destroying the dollar's value. They started buying silver, millions of ounces. But they didn't just trade futures contracts for profit, they did something nobody expected. They took delivery. Most futures traders settle in cash. It's a paper game. But the Hunts demanded the actual metal. Every contract they bought, they took possession. By late '79, they controlled half the world's deliverable supply. The price went from $5 to $50 in 12 months. The exchanges panicked. They were running out of physical silver, so they changed the rules mid-game. Silver Rule 7. No new long positions allowed, liquidation only. The Hunts couldn't buy anymore. Short sellers could pile on unlimited. The price crashed 80% in 10 weeks. March 27, 1980, Silver Thursday. The Hunt brothers couldn't meet margin calls. Financial ruin, personal bankruptcy, everything lost. But here's what nobody talks about. The people who held physical silver through the crash still came out ahead, because even after the collapse, silver stabilized at $10. Double what it had been 18 months earlier. The lesson was clear. Paper promises can be rewritten. Rules can change. Contracts can be voided by regulators. But physical metal in your possession, that's real. Nobody can dilute it. Nobody can hypothecate it 7 different ways. Nobody can print more of it. That's what makes this HSBC situation different from every other financial crisis. This isn't about derivatives or synthetic products. This is about a finite physical commodity. And when banks start competing to buy millions of ounces on the open market to cover positions they never should have sold, the price rises until supply and demand actually balance. HSBC's model says $312 per ounce. That's their estimate for covering their position. But what happens when JP Morgan needs to cover? When Scotia Makata does? When UBS does? When every major bullion bank tries to source physical silver simultaneously? 312 isn't the ceiling, it's just the beginning. Because unlike 2008, you can't solve this with monetary policy. You can't print silver. You can't create it with quantitative easing. Either it physically exists or it doesn't. Right now it doesn't. Think about this for a moment. Every system built on leverage eventually faces a reckoning. Every promise that exceeds physical reality eventually breaks. Not because of regulation, not because of oversight, because of math. Simple, cold, unavoidable mathematics. When there are 100 claims for every ounce and everyone wants delivery, somebody doesn't get their metal. When vaults holding 4.8 million ounces owe 18 million, somebody is missing 13 million ounces that don't exist anywhere. When banks project paying $312 to cover positions they sold at 80, somebody is absorbing a catastrophic loss. That somebody is either the bank or the person holding their promise. If you're holding unallocated accounts, if you're holding ETF shares that explicitly state in the prospectus you cannot redeem for physical metal, you're the counterparty. You're holding the empty bag when the music stops. 29 days remain. That's not much time. And if you're waiting for this to hit mainstream financial news, for talking heads on television to explain what's happening, you're already behind. By the time the general public understands, dealer inventories will be depleted. Premiums will be 50% over spot. Delivery times will stretch into months, if dealers are even accepting orders. Right now, premiums on American Silver Eagles are running 15 to 20% over spot. 3 months ago, they were 5%. Dealer websites show low inventory warnings. Products that used to ship in 3 days now ship in 3 weeks. These aren't random fluctuations. This is what the early stage looks like. And here's what makes this fundamentally different. When stocks crash, you lose money, but the shares still exist. When real estate drops, you lose money, but the house still stands. When crypto collapses, you lose money, but the blockchain still operates. When a silver shortage is confirmed, when the fractional reserve game is exposed, when it becomes mathematically impossible for banks to deliver on their promises, those paper claims become worthless, not worth less. Worthless, because they represent metal that isn't there. Physical silver in your possession, that becomes irreplaceable. Because it's the one asset nobody can manufacture more of, the one thing that can't be hypothecated into 7 different claims, the one thing with intrinsic value that doesn't depend on someone else keeping a promise. I'm not telling you what to do. I'm just showing you what the pattern reveals. The setup happened. The expansion happened. The crisis is unfolding right now, and the collapse arrives in 29 days, maybe sooner. History doesn't repeat exactly, but the rhythm is unmistakable. And right now, every beat sounds identical to 68, to 80, to every precious metal crisis that's ever played out. The difference is you're watching it develop in real time. You can see the fractures forming before the structure fails. The question isn't whether this happens. The mathematics make it inevitable. The question is which side you're on when it does, the prepared or the unprepared, the physical or the paper, the winning or the losing. 29 days. The Singapore vault remains empty. HSBC is still scrambling. The deadline still approaches. And somewhere right now, another investor is requesting an audit. Another person is demanding their silver. Another account holder is discovering their allocation doesn't contain what they thought it did. The pattern is unfolding exactly as it always has. The only variable is you, what you do with this information. Whether you understand what it means, whether you act while the window remains open. Because once the public realizes what's happening, once the scramble becomes obvious, once the price starts moving violently, the opportunity closes, the metal disappears, and you're left holding paper promises from institutions that can't honor them. The clock runs down, the vault stays empty, and February 28th approaches whether you're ready or not.